It's all powered by the Vincent Financial Group. Coming up this weekend, President Biden thinks the economy is in great shape. What say you? Plus, can you really inflation-proof your retirement? We'll get to that plus a lot more. 770-741-0120, retireatlradio.com. My name is Mark Owens. Aaron Vincent, Matt Decker, how y'all doing this weekend?
Fantastic. Doing great. Summer's here.
Summer's here?
Yep.
I know sweat stains are coming in the hats already.
That's right. Yep.
Listen, when you're follically challenged like I am, I run through hats pretty quickly. So it's a bit of a hobby. It's a bit of an obsession, all the hats in the back of my car. But, Aaron, we talked a little bit a couple of weeks ago that you have a pretty big trip coming up with you and your family. Going on a mission trip to...
Yeah, we're going to Mozambique, South Africa, and Zimbabwe.
I love that. So where is your head in putting together a trip like this? Half mission trip, half little time with the family.
Yeah, it's great. Well, so it's a lot going on. Thankfully, my wife has handled a lot of the logistics. Otherwise, my head would be just a jumbled mess of all that. All the travel in between places and planning and kids, supplies, clothes, what to plan for, all that, because we're doing so much. We're going to be working with some people that we know there, building some schools and really kind of trying to help strengthen the team there in Mozambique. But then also we're taking some time to see Victoria Falls and go on a safari and see all the African animals. And so a wide range of activities and just planning for all that stuff. So my head is mostly just excited. I mean, I'm kind of go with the flow. Let's have fun, make memories. And thankfully, I got some folks in my corner that are planning the details.
Yeah, and that's where, Matthew, you come in, too, because as another strong member of the Vincent Financial Group, it's kind of cool that Eric can take some time off, do some good things for the world, do some great things with the family. And you got everything. You're holding it down.
Holding it down. Yeah, we've got a lot of contingency plans in place for when Aaron goes out, and we're glad that he's able to do it. I don't know if you mentioned he's taking the whole family, so kids too.
Yeah.
And it's going to be a great trip. We're excited that he's going to get to go do that. We're huge supporters of the school down there in Mozambique, and so I'm glad that he gets to go. Yeah, maybe in a couple of years I'll go with the family. Right. We'll see.
Absolutely. It's cool to see, we have a great team at our office, and to see them get to kind of step up and fill in the blanks whenever me, in this case, or Matt's out, it's good.
Good. You can meet the team when you visit retireatlradio.com. Again, Retire ATL Radio. The entire team see all the services they offer at the Vincent Financial Group. All right, gentlemen, let's get to it. Stock prices, they're testing all-time highs. Some big names like Jeff Bezos, Zuckerberg, they've sold off millions of dollars of their company stock. Now, one analyst told Fortune magazine that the cash out could be because of the election, already tired of it, possibly shaking things up this fall. So when the market is up, Matt, and the rookies are buying but the pros are selling, is this one of those foreshadowing events that there could be a pullback?
Well, I definitely understand the sentiment. You don't want to be the rookie who's late to the party and takes it in the teeth. You definitely don't want to be that guy.
Yeah, for sure.
But I also think, we're talking about, two of the richest men in the world, and they can take profits whenever they want. They've kind of earned that right to do that. And that's taking profits, that's something that I learned back in more of my trading days. And it's something that it is hard to do, and we're not necessarily traders, we're more planners. But, whenever you see big names like that selling shares of stock, typically I'm going to view that as that's a guy who's taking some profits off the table. And as you approach retirement, that's actually what all of us will end up doing. We will end up taking some profits off the table, taking some risk off the table in order to secure maybe something that's a little bit safer or secure an income stream. And so I totally understand the sentiment. I don't know if, Aaron, you have anything to add about that. I understand the sentiment, but also, we don't want to let those guys and the billionaires kind of freak us out about overall market expectations.
Right.
All I see here are two guys probably looking to upgrade their yacht or something along those lines.
Their fourth yacht. Upgrade their fourth yacht.
Get another one.
Yes.
So, no, in all seriousness, could this be a signal of something? Maybe. But I just think that getting stuck in what this might be or what this could be, and it's an election year, so could it be that we're reading into things maybe too far by assuming that someone selling stock means that we're in trouble?
Right.
I think that there are significant or really important, strategies and principles that we can adhere to that allow us to avoid situations like this. If all of your retirement planning funds are in Facebook or Amazon stock and you start to see the CEOs selling off, then you might have some problems. But that's the whole point, is not being concentrated into too narrow of a stance of your holdings in your investment accounts. That's what we talk about every day. And so no, this may just be par for the course. This may be just a normal everyday, hey, it's second quarter, time to take some profits or whatever it may be. And it could be an indicator of something, but to get pulled around and tossed around as a retirement planner or as a retiree or someone saving for retirement, I think could be a big mistake to see isolated situations like this and knee-jerk respond to it.
I have to say that I got a confession to make.
Uh-oh.
Yeah, a couple years ago.
Hold on, let's open the booth real quick. All right, come on in. You're in a safe space.
All right, safe space.
No judgment here.
Okay,
No
WSB audience is going to take it easy on me?
100%.
Okay, I hope so. About 4 years ago, another election year.
Oh.
About 4 years ago, Matt, myself, I was doing a little reading into the headlines and thought I might exercise an opinion that I had on the market. I thought it was going to fall through the bottom. And so I went to my financial advisor, who's Aaron.
I recall this conversation.
Did you have to set an appoint with him?
I did.
About 3 weeks out.
I had plenty of room. I just made him wait.
I didn't meet the minimums, and so I got on the long waiting list.
I'm not a miracle worker, Matt.
Yeah, exactly. I met with my financial advisor, who's Aaron, and I said, hey, man, I want you to move all my IRA funds to cash. And he just kind of looked at me, and he's like, well, okay.
I'm like, you're 37, Matt.
Yeah.
Okay.
But when are you going to get back into the market? I'm like, I'll know when I know. And every week or so, Aaron would come back to me and, so Matt, still got you in cash there. I'm charging you a fee, Matt, to have your money in cash. Should I reallocate it? No, a little bit longer. Long story short, I am now back in the market and have been for several years. But of course, I missed a huge run up in the market that my account could have experienced, and it didn't because me, the guy who's supposed to, I'm the financial advisor, I'm the CFP, but even I can get emotional.
Yeah.
Even I can read into the headlines and get fearful and make mistakes, and I did. And, Aaron, being a good financial advisor, he came knocking on my door every week or so saying, Matt, is it time? Is it time? Is it time? I should have listened to you from the jump, but hey, lessons learned.
I could tell some stories about when I should listen to Matt too, but for this topic, I think, I recall those conversations, pretty well. And I think that everyone at certain times, even financial advisors, even CFPs included, fall prey to the headlines, the emotions, the what ifs, the fear, whatever it might be, and not responding to those feelings. I mean, in life in general, not just talking about only money or only retirement planning, just in life in general, to have a feeling about something that you feel strongly about, and to have the, whatever you want to call it, discipline, maturity, I don't know what you want to call it, but to have the ability to to decide not to obey that feeling and stay the course is way easier said than done. We could all tell stories. I certainly could too, about times where I made a decision and fell prey to the winds that were blowing and got tossed this way or that way about whatever was going on. And I think there was a study done years ago. It's called the Dalbar study. If you have any interest,
They do it every year.
Yeah, well,
every year they do a new Dalbar report.
Right,
yeah.
And we actually used this a few years ago, to sort of look at and kind of assess our practice, right? And one of the things that it talks about is how a good financial advisor actually, the fee that they charge you, even if, and I'm definitely paraphrasing like big time here, but even if the performance of your portfolio isn't stellar, even if all they do is play psychologist and keep you from yourself, even if that's the only value that you get, regardless of portfolio performance and all that kind of thing, even if all they do is keep you from making knee-jerk emotional responses, then they're way worth their fee, like 2 or 3x the fee if you take the average fee that most financial advisors charge. So then you layer on there, if you've got a good financial advisor and they're doing good planning, they're diversifying well, et cetera, then it's even exponentially better. But even if all they do is keep you away from your own emotional knee-jerk responses, their fee is the value that you get from that is way more than the fee they charge. And so that principle, I think, in that study over, I believe it was hundreds of thousands of different data points, it's pretty telling.
They do it every year. Yeah, that's a great point. I forgot about the Dalbar study when we were talking about market pullbacks, but there's something in that study called the guess right ratio, I believe is what they call it, the guess right ratio. And it's essentially the retail investor, the person who's managing their own funds, no financial advisor, just retail investor, when they try to time the market. So we're talking about market at all-time highs or approaching all-time highs. People are selling. What do I do? Do I get in? Do I get out? Am I the rookie or am I the veteran? You know, that guess right ratio says that 1 out of 4 people guesses correctly. 3 out of 4 get in or out at the wrong time. And so here I am saying that I was part of the 3 out of the 4 4 years ago, trying to go to cash, thinking I knew something. Turns out I didn't know anything. And that is exactly one of the main benefits of a good financial advisor is keeping you from yourself.
And to take that principle even farther, you know, let's just pretend that you were the one of the 4 that timed it right. Well, the chance of you timing it right again next time, no, you'll be one of the 3 of the 4 that got it wrong next time. So yeah, it's
Aaron would have just taken credit for it anyway.
Absolutely,
exactly.
Totally.
But I like that you said that. You know, you said that y'all work together, obviously, but you challenge each other as well. Like Aaron, you were saying, "Are you ready? Are you ready?" And Matt, I want to go back to something you said about pulling your money out of the market. 770-741-0120. Again, 770-741-0120. To reach out to Aaron, Matt, and the team at the Vincent Financial Group. If you have any questions about this weekend show, you want to sit down, take advantage of that no obligation consultation. We'll get to that in just a couple of seconds. But Matt, you said, "I'll know when I know."
That's right.
And he's like, "Are you ready?" "I'll know what were you looking for?"
Oh, man.
That's a good question.
That's a great question. I wish Aaron would have asked me that question. I think he was letting me off the hook easy. What was I looking for? I think I was looking for my feelings to just go away.
Okay. Is that emotions in investing?
Yes. Yeah.
That's something that we are bad about.
I was waiting to get out of my feelings.
Yeah.
Yeah. Which is the absolute wrong place to be for someone who's my age, because I was letting fear keep me from sticking to the plan. And my plan at 37 years old looks like, you know, take as much risk as you possibly can over the next 15 years or so, and then start to dial it back. Now, if you're approaching retirement or if you're already in retirement, then obviously your risk profile looks a whole heck of a lot different. But I think what I was waiting for was I was waiting just to, I was waiting to feel better. I was waiting to not be so nervous. I was waiting to not be so fearful. And, you know, you get caught up reading the headlines, and again, it was an election year, so there's lots of turmoil, and it doesn't matter who you're voting for. You know, there's things that are going to scare you no matter what side of the aisle you're on, right? The other side has something to say. And so I think I was just falling prey to those type of fear stories that you see all over the place.
And most of our, especially on this topic, most of our feelings or our fears or our emotions come from something external. I read an article, or I saw a headline, or my neighbor's opinion, or whatever it might be, or Bezos selling off Amazon stock, whatever it might be. And so if you're in that cycle, then you're waiting for a new headline to course correct, to encourage you to be like, I'm not fearful anymore. Well, guess what? 9 times out of 10, if not more often than that, you missed it at that point.
Yeah.
If you're waiting for the headlines to tell you to get back in, you're a month behind and you already missed it.
That is the definition of being the rookie. Waiting for the headline to tell you it's time to get back in. Waiting for the talking head to tell you it's time to get back in. That is being the rookie investor.
And I think another thing on that point is, look, there are ways to manage a portfolio or to save or to invest that don't require this jumping in, jumping out, fear, confidence, kind of that turmoil. There are ways, principles to adhere to that allow you to sort of weather that storm, because what do we know that markets have always done and therefore will probably always do? They will go up and they will go down. It's going to happen. So to assume that they're going down means the world's on fire and I've got a giant problem is not necessarily the case if you've got a well-built portfolio. And so dollar cost averaging is a term that, you know, if you're into investing or if you talk to a financial advisor, you've heard that term before, you may not know what it means. All it means is that you're buying or selling at regular increments. So whether markets are up or down, let's just use monthly as an example. You're putting in $1,000 a month and you're buying as the market's going up, and you're still sometimes buying as markets are going down, but you're buying at different levels. And so you're diversifying just by the timing at which you're buying investments. And there are principles like that. I don't want to belabor that point too much, but there are just principles that we talk about every day that allow you to not have to be, succumb to all these different waves of change and fear and all that kind of stuff. It's probably the best part of my day is helping people get out of their own heads as far as this is concerned.
Yeah, don't be like me. don't be like me. Listen
learned,
to your
though.
advisor.
Right. But the fact that was a great learning lesson for you.
It
Matt,
was.
if nothing else.
I think Aaron and I are such close friends. We're literally like brothers. Our families vacation together. Our kids hang out together. I think I just didn't want to listen to him. He's,
like a good brother.
Yeah, he's a little bit older than me, so he's like big brother, and I'm like, big brother doesn't know anything. I know when to get in and out.
But then it's like you get older and you're like, dang it, he was pretty smart.
He was right.
He actually knew what he was talking about. That's not how this is supposed
And I can
to
relate
work.
on being a Falcons fan. I'm jumping in, jumping out all the time because it's so painful. So
Hey, that Braves bandwagon is full, and then empty, and then full and then empty right now. 770-741-0120. Again, 770-741-0120. Don't be afraid. Don't let the fear take over. You can ask these questions to the team at the Vincent Financial Group. That initial consultation, it's no cost, it's no obligation. And, Matt, we say it always, we say it often. We want to talk to the people. You've done a good job for saving. You got a savings account, nice 401k, an IRA, a pension. But as you just said a couple of minutes ago, you're not miracle workers.
Yeah.
You need to have a little bit of something in that account to really start customizing, to start building upon that plan. Or if you just need that second opinion, it's no cost, no obligation. 770-741-0120. Retire ATLradio.com. Talking about Bezos, Zuckerberg, some of the richest adults on the world and on the planet right now across the world. Some of the richest Americans have saved for retirement. It's probably a little bit less than you think. Now, we're going to take those two names out of this conversation. But there was a new Fed survey that said the top 10% of households by net worth had an average of $1.2 million in their retirement accounts. Now, you may have saved $500,000 for retirement. You're going to be just fine. But, Aaron, there is someone who saved $5 million that could really be in trouble. So have you worked with people that, man, that looks great on paper, but the reality is we got a lot of work to do?
absolutely, this is a big one. Expectations are crucial for life in general, and so. Matter of fact, it's been in the last couple of weeks. We were talking to a gentleman who, really good saver, had a lot of success in his life, net worth pushing $20 million. However, he needed upwards of $1 million per year in income in retirement. That's what his goal was, to spend during his retirement years.
Well, that's what he said he needed.
That's what he said.
That's what he said.
Whether or not that's actually true, who knows? But from his perspective, his expectations, his goals, that's what he wanted to try to achieve. Well, if you're going to plan for a 30 or even 40 sometimes year retirement, most folks out there would say $20 million. I don't care what my budget is. I'm good. I'm good to go. If I was that guy, I'd be good to go. Well, on paper, yeah, to your point. But and then there's other situations. Matt's got some great stories. He's told me about his grandparents and how they lived in Illinois. Matt, why don't you tell us about that situation?
Yeah. So just for the background and the context, my dad grew up not poor, but certainly not wealthy, to the point where farming community in Illinois, and every single year they would, after the corn was harvested, after the combines went through the fields, my dad and his brothers and sister, they would all grab their pillowcases and they would go out into the fields and they would pick up ears of corn that had been dropped by the combine. They'd walk them over to the weigh station and they'd earn, I don't know, $5, $6, $7, and they would use that money to buy their school supplies.
Wow.
So like those are my roots. Like that's where my family comes from. So certainly not living high on the hog, walking through the fields, picking up corn to buy school supplies. But my grandparents, they were both school teachers, and they certainly didn't make a ton of money as school teachers, but as the audience well knows, you're a school teacher, you get a pension. Mm-hmm. And so my grandpa always remained invested. He had some investment accounts, and he was 100% equities essentially his entire life. Ever since he started saving to the day he died, he was 100% equities. And when they retired, they lived off of Social Security, and they banked both of their pensions. And my grandpa passed away with about $2 million in his investment account, and yet my dad was every single year walking through cornfields, picking up ears of corn to buy school supplies. Yeah. And so it just goes to show, how much you've saved is only one side of the equation, or it's one variable in the equation. Another important variable is how much you're going to spend. And if you're frugal, if you're somebody who knows how to live below your means, and you're watching your budget, it could very well be that you don't need to be in the top 10% of Americans with a net worth of $1.3 million to retire better than you've maybe lived while you were working. My grandparents' retirement was easier, and it was more luxurious than their working years. And that could be you too. It all depends on, it's two things. How much are you saving, and what are you spending?
So there's two extremes. I think most folks are in between. You got the guy I mentioned initially who, wants to live on $100 or on $1 million a year in retirement. Then you got, people who are just living off their Social Security alone. But most folks are in between there. But yeah, the question really doesn't, you can't answer the question, I should say, based on a certain dollar amount in my account. Hey, is this much money, in this case of $1.2 million, is it enough? Well, I got about 5 more questions to ask to be able to answer that question. It's a very important question, and that's maybe where we should get started in our conversations. But to say that a certain dollar amount without knowing anything more about timing and expectations, and some people that we talk to every day or every week, they're preparing for retirement. They've got their home paid off, no mortgage. Other folks just moved into a new home, just started a new 15 or 30 year mortgage, and just planning on paying their mortgage out of their retirement income every year. And that's just one example of many where we could just say, man, it depends on so many things. It's not just a dollar amount in your savings.
How many times have somebody come to you and they said, excuse me, Brandon, how many times has somebody come to you and they've said, man, I know I got a lot of work to do. I've been working really, really hard. I've been saving. I've been working on my budgets, and I know I'm not there yet. And you can look at that and you can say, yes, you are. You're doing fine. Everything you're doing is right. Does that happen a lot?
I think it happens maybe a majority of the time. Most people don't come into our office completely unprepared.
Yeah.
Even if they think I'm behind. My experience has been, and maybe you can share your experience, Aaron. My experience is a lot of that comes from comparing to someone else. They're comparing themselves to their neighbor or their brother, their sister, their parents. And that's just not, you can't do that, right? Everybody is their own person. Your retirement's going to look different than someone else's retirement. And I think most of the time people are coming in much better shape than they expect.
So maybe you're asking yourself this weekend, where am I? How am I doing? Well, the best way to find out is to give the team a call. Schedule that no-cost, no-obligation consultation. 770-741-0120. Again, 770-741-0120. Maybe you've saved $500,000 for your retirement, $1 million, $2 million, $3 million. Where are you? Is that going to be enough to sustain you through your retirement? 770-741-0120 or retireatlradio.com. Quick break. When we get back, can you really inflation-proof your retirement plan? We'll get to that plus more. This is Retire ATL, and it's all powered by the Vincent Financial Group.